Welcome everyone. Today, we're diving into a topic that affects millions of Americans every day, debt. More specifically, we're going to talk about a strategy that can help you take control of your debt and get on a path to financial freedom. It's called Consolidate and Conquer: How to Simplify Your Debt. Whether it's credit cards, student loans, personal loans, or medical bills, managing multiple debts can feel overwhelming. But don't worry, we're here to simplify this for you and show you how to tackle it one step at a time. Imagine debt as a bunch of tangled cords. Each cord represents a different loan or bill, and when you try to untangle them all at once, it can be frustrating. Debt consolidation is like grabbing those cords, grouping them into one, and plugging them into a single outlet. Instead of managing multiple payments with different interest rates and deadlines, you're left with one simplified payment. This can make managing your finances much easier and, importantly, less stressful. Now, let's start with the basics. What is debt consolidation? In simple terms, it's the process of combining multiple debts into a single loan or credit line, usually with a lower interest rate. This is particularly helpful if you have high-interest debt, like credit card balances. By consolidating, you streamline your finances and often reduce your monthly payment, freeing up cash flow that can be used elsewhere in your budget. But here's an important tip. Consolidation isn't about erasing your debt. It's about managing it more effectively. A lot of people wonder why debt consolidation might be a good option. Well, think about your current payments. If you're juggling 5 different bills every month, it's not just about the money, it's the mental load too. Having one payment instead of 5 simplifies your financial life, reduces the risk of missed payments, and can help improve your credit score over time. Additionally, by securing a lower interest rate, more of your payment goes toward reducing the principal balance instead of just covering interest fees. This can help you pay off your debt faster. When should you consider consolidating your debt? This is an important question. Not everyone is a good candidate for debt consolidation. It's most effective if you have multiple high-interest debts and a good credit score. If your credit score is strong, you can qualify for better loan terms. If your credit score isn't great, you may still be able to consolidate, but the interest rate may not be much lower than what you're already paying. It's crucial to evaluate your current debts, interest rates, and the offers available to you. For example, if your credit cards have interest rates of 20% or higher, consolidating into a personal loan with a 10% interest rate could save you a lot of money in the long run. How can you consolidate your debt? There are several ways, and it depends on your financial situation. One popular method is a personal loan. Companies like SoFi, Marcus by Goldman Sachs, and Discover offer personal loans specifically designed for debt consolidation. These loans often have fixed interest rates and predictable monthly payments, which can help you budget better. Another option is using a balance transfer credit card. This is where you transfer your high-interest credit card balances to a new card with a 0% introductory interest rate for a limited time, typically 12 to 18 months. This can be a great way to make a dent in your principal without accumulating more interest, but you need to pay off as much as possible during the promotional period before the regular interest rate kicks in. There's also the option of a home equity loan or a home equity line of credit, HELOC. This uses your home as collateral, allowing you to get a lower interest rate. However, it's risky because if you can't keep up with the payments, you could lose your home. It's best suited for people with a good amount of home equity and a strong repayment plan. You might be asking, who can help with debt consolidation? Aside from banks and credit unions, there are specialized debt consolidation agencies like National Debt Relief and Freedom Debt Relief. These agencies offer counseling and assistance in finding the right consolidation plan for you. However, be careful and do your research. Unfortunately, There are scams out there that prey on people in tough financial situations. Check reviews, look for accreditation with the National Foundation for Credit Counseling, NFCC, and don't pay upfront fees. Debt consolidation can sound appealing, but it's not a magic bullet. Let's talk about when debt consolidation might not be the right choice. If your spending habits haven't changed, consolidating might just give you more room on your credit cards to rack up more debt, leading to a cycle that's even harder to break. It's crucial to address the root cause of your debt. This means setting a budget, cutting unnecessary expenses, and possibly increasing your income through side gigs or a new job. What are some real-world examples and current trends in debt consolidation? With inflation rates rising, many people have found themselves relying on credit cards to cover everyday expenses. According to recent reports by Experian, credit card debt in the U.S. reached an all-time high in 2023. With high interest rates, consolidating the debt has become a popular solution for those looking to regain control. Companies like Upstart and Lending Club have seen an uptick in borrowers seeking personal loans to consolidate their high-interest credit card debt, highlighting the growing need for financial solutions. To put this into action, let's discuss a few actionable tips you can start using today. First, review all your current debts. Write them down, including the total amounts owed, interest rates, and minimum monthly payments. This will give you a clear picture of your financial situation and help you decide if consolidation is the right move. Second, check your credit score. You can get a free credit report from websites like annualcreditreport.com. A higher credit score means better loan terms, so if your score needs work, consider improving it first by paying down smaller debts or disputing any errors on your report. Third, shop around for consolidation options. Don't just take the first offer you get. Compare interest rates, fees, and repayment terms from multiple lenders to find the best deal. You can use comparison tools on websites like NerdWallet or Bankrate to help you make an informed decision. Before we wrap up, let's do a quick recap question. Think about your current financial situation. What is one step you could take this month to start simplifying your debt? Maybe it's creating a list of all your debts, or perhaps it's checking your credit score. Write it down and commit to taking that first step. In summary, debt consolidation is a powerful tool that can help simplify your finances, lower your monthly payments, and reduce stress. However, it requires discipline and a strong plan to be truly effective. Remember, consolidating your debt doesn't eliminate it. It restructures it in a way that's easier to manage. Take the time to evaluate your options, understand the terms of any new loan or credit product, and create a budget that helps you stay on track. Debt can feel like a mountain, but by consolidating and conquering it step by step, you can clear a path to a more secure financial future. Take action today, get informed, and make choices that will set you up for success. You've got this, and every small step you take now will make a big difference down the road. Thanks for listening, and here's to conquering your debt and building a brighter financial future.